Namaskar, greetings friends. Today I'm going to share with you a video that I recorded more than 10 years ago in October of 2013. This video talks about how to identify trends on charts, how to draw trend lines, and then how to utilize trends for your trading decisions. Whether you play along the trend or you take decisions when the trend is fading. But before I go into the recording, as always, a quick word of statutory disclaimer. The information being shared in this video is for educational and informational purposes only. It should not be construed as an investment advice. Individuals are encouraged to do their own research and assume full responsibility of any actions taken based on the suggestions provided.
Trend lines is a very simple concept, but it can be a very powerful tool if used correctly in making your trading decisions. It can be used as a sole tool to formulate a trading strategy, or it can be used alongside other tools. So in part 1, we will talk about how to define a trend in any given time frame and how to draw trend lines correctly. And in part 2, we will cover some strategies using trend lines. Okay, we'll use trend lines to both go with the trend as well as take trades against the trend when price breaks the trend lines. Going to the definition of a trend, when you look at a price chart on your screen, just by the visual inspection you can tell whether the price is making sideways movement or it is in an uptrend or a downtrend. If price is making a structure moving from bottom left of your screen to the top right, it is in an uptrend, and vice versa. If it is moving from the top left of your screen to the bottom right, it is making a downward trend. However, technically speaking, a price is supposed to be in an uptrend as long as it is making consecutive higher highs and higher lows. Okay, and that's applicable to any time frame and any time box. If it is making higher highs and higher lows consecutively, it is in an uptrend till it breaks that. And likewise, it is said to be in downtrend if it is making consecutive lower highs and lower lows. Okay, just to illustrate my point, let me use a drawing tool. If price is making this sort of structure, you can visually tell that it is in an uptrend, okay, because it is going from the bottom left of your screen to the top right. However, let's look at the structural highs and lows to see if it is making a technical trend as well. So it is a low here, prints a high here, then comes back and prints a new low here, which is higher than the previous low, so it is a higher low, prints a new high which is higher than the previous high, so higher high, another low which is a higher low, higher high, a higher low, higher high, a higher low. So as long as price continues to print a structure like this where it prints consecutive higher highs and higher lows, it is said to be in an uptrend until eventually price takes out the latest or the previous higher low. Okay, so if it breaks underneath this point, then it is supposed to have broken that trend. It was in trend from here up to literally this point. Okay, as soon as it broke down, the trend is broken. So this is your definition of uptrend. So technically this structure is in an uptrend. Clean one and try to draw a similar picture for a downtrend. Let's examine technically. Again, visually speaking, it is moving from the top left of your screen to the bottom right, so it is making a downward trend. But technically speaking, let's examine the highs and lows of the structure. So it is a high here, prints first low here, then a new high which is lower than the previous high, so a lower high, a new low which is a lower, so lower low, a lower high, a lower low, a lower high, lower low, lower high. Okay, so again, technically speaking, it is meeting our criteria in that it is making consecutive lower highs and lower lows. Okay, so it is in a downtrend until the price eventually breaks the latest lower high, which is this point. Okay, so that's the definition. It meets the definition of our technical downtrend. Again, to repeat, uptrend has to have consecutive higher highs and higher lows, and downtrend has to have consecutive lower highs and lower lows. Okay, once you've identified that structure, then the next thing is how to draw trend lines correctly. For an uptrend, the trend line has to be drawn under the price structure. It has to be drawn in such a manner that you join at least two higher lows. because you're drawing it under the structure, it has to be joining two higher lows in such a manner that the entire price action for that structure remains above the line. Okay, so remember that you can pick up any points. They need not be consecutive higher lows. They can be any two higher lows in the structure, but the line has to be such that the entire price action is above that line. Some people draw trend lines using only the candle bodies and they ignore wicks. I personally don't like that. I'm a big fan of using the entire price action using wicks. And the reason for that is wicks are formed for a reason. Wicks are formed because at those points there has been a price action. There has been trades which form the wicks, and therefore you cannot ignore them. Let me just go back to the drawing and see how to draw on an uptrend. Let me open the uptrend file. On this one, as I said, first of all, it has to be drawn under the structure. So it has to come here, somewhere here. It has to be drawn in such a manner that I pick up any 2 points and join them in such a manner that the structure doesn't cut that line. Okay, so I have to pick up carefully. I have to pick up those points which kind of fall outside of the structure. So this is probably 1 point structure, and this is the other point. So if I join those 2 points and extend it, so the entire price action is above this line. Okay, if the other points don't touch it, no problem. As long as 2 points touch it and the entire price action is above it, it's fine. So it's a valid trend line. Let me just try and pull the other chart. For a downtrend, the trend line has to be above the structure. You pick up any 2 points which cover the entire structure. So in this structure, you will see that these 2 points seem to be the points where if I draw a line touching them, then rest of the price structure will be underneath. If I picked up these 2 points, then probably the line will cut through this price structure. So that's not valid. Going back to my slides, so for an uptrend, join any 2 higher lows in such a manner that all price action is above the line, including wicks. And for downtrend, join at least 2 lower highs in such a manner that all the price action is below the line. Okay, so that's how you draw trend lines correctly. Now what I'll do is I'll switch over to real charts and try and find some examples. So this is a USD CHF chart currently in 4 hourly. On the 4 hourly, let's look at the right side of the screen. You'll find that this structure here is making a trend. All you need is at least 2 points and draw a line in such a manner that the entire price structure is above it. Yeah, this structure is making an uptrend. Yeah, let me draw a downtrend. If you join this point here up to this point, it was in a downtrend. In fact, the downtrend was broken at this point here. The price action from here up to this point was in a downward trend, and from this point up till now, up to current, it is an upward trend. So this is how you draw. So that completes part 1. In part 2, I'll talk about how we use these trend lines to make some trading decisions. There are many ways in which you can use trend lines. One, you can trade with the trend. I think for that you'll have to join the trend in its infancy, otherwise it will be too late, maybe too late. Or you can go against the trend when a trend has matured and it is ready to break the trend. Then you can fade the trend, so go against it. The third approach is to use a combination of the two. So you look at 2 different time frames, find trends in 2 different time frames, and go against the trend in shorter time frame to join the larger time frame. So we'll talk about these 3 approaches to using trend lines for making strategy and to make your trading decisions. You can use them to formulate your trading strategies on its own, or you can use them as an additional aid alongside other tools. Let me draw my drawing tool. So on this chart, I've just drawn a very symmetric upward trend, and this is just for illustration. I'm using only upward trends, but the principles are applicable even for downward trends, and you can use the strategy that I talk about for downtrends as well. Now on this chart, as you see, when the price starts making this move from here, it prints a high and then comes back and prints a low, which is higher than this low. So it prints a higher low. Now the moment it does that, you've got to be looking for the trend formation. By technical definition of a trend, the moment you've got two pairs of higher highs and higher lows, it is in trend. Okay, so you are looking at this point here where it previously printed a high here. So at the time it breaks through this high, technically the price is in a rising trend. Therefore, in order to join this trend, I would recommend taking a long position at the break of this point. So you take a long position here with the protective stop just below the previous low. Because the price is broken, obviously it will print a new high. That means it is already in a trend. Now, if after printing this high it comes back and breaks the previous low, you will get stopped out, so you make a loss. However, if it continues to follow the trend, which is it has just started forming here, then in all probability it will go and break this high as well. The moment price break this high, you move your stop from the initial stop position, which was here, to just under the new higher low. Okay, so you are trailing your stop loss to the new higher low, and you keep doing that as long as price keeps making new higher highs and higher lows. So when price breaks through this, you move the stop here. When the price breaks this position, you move the stop here, and so on, so on. Eventually there will come a point when the price no longer continues the trend and it breaks not only the trend line but also a previous higher low. Now by this time you would have moved your stop loss here. When this happens, you will be stopped out. Okay, you will be stopped out automatically because you would have moved your stop loss here. But by that time you would have booked a profit of, so this was your entry. Yeah, you would have booked this much profit, and if you see your initial stop was this much, so there's a substantial profit to be made. Now you're able to do that because you joined the trend at its very infancy. Now there is always a chance that having just looked at two pairs of higher highs and higher lows, and the trend may actually not form at all, so you'll make a loss, but that's life in trading. I have demonstrated only a rising trend, but the concept is applicable for a declining trend as well. We'll now look at the second strategy, which is fading the trend. For that, let me just pull up another picture. When you look at a chart and it is already in a trend and it has traveled a fair distance and you have not been able to join at an early stage, then my recommendation will be not to jump in the trade in the middle of a trend. However, wait for it till a point that it breaks the trend. So in this particular case, let's say the price is making a trend like that and you spotted it somewhere here. So my suggestion will be to wait till it breaks your trend line and also the previous higher low. Okay, so when it does that here, you enter a short position. So your entry will be through a sell stop just below this, and your initial stop loss will be above this, above the previous high. Now if the price goes back and takes the previous high, then you would have lost the money and you'll be stopped out. However, having broken this trend, there is a likelihood that the price will actually start going down in waves like this. Your initial short entry was here with the protective stop here. Now when price breaks the previous low, which is the low here, when it breaks the low here, at that point you move your stop loss just above this. So you're moving your stop loss here and it goes like this and again here. So when it breaks this position, you move your stop just above this and you ride the trend like that. It is just the opposite of what we have seen in the previous chart, but you're taking a trade when the trend has exhausted, okay, at the break of the trend in the opposite direction, by taking an entry in the opposite direction at the break of previous high low, stop loss just above the recent most high, and then trailing the stop loss as the price starts making a structure downward. So this is called fading the trend strategy. Finally, let's look at combination of these two strategies. So for that, let me just bring out another picture. In this particular strategy, we are looking at two different time frames. So let's say this is an hourly time frame, and the price is making an uptrend on hourly. Okay, so this is hourly and it's making an uptrend. Now typically what happens when you look at a price chart, due to the fractal nature of price movements, when you look at smaller time frames, in all probability the price will be making waves like that. So the idea of this strategy is to look for a trend in a smaller time frame which is in the same direction as the larger time frame trend, and then wait till that breaks down, and then you basically take a position opposite the shorter time frame, exactly the way we discussed in the previous picture. So enter short here and stop loss above this. In this particular case, you ride the price only up to the point that it touches your trend line. So you're not risking the break of this trend line because this is a higher time frame trend line and it is hard to break. In this particular case, sometimes the risk to reward could be very small, therefore you've got to be more careful. However, this strategy supports the very nature of price movements, which is reversion to the mean. So when price goes steeply like that on a shorter time frame, in all likelihood it will come back to visit the mean, which is the larger time frame trend line. Therefore it is quite a safe trade, but as I said, the risk to reward can be small, and therefore you have to just see how much reward there is for the risk you're taking, and if it doesn't stack up, then don't take the trade. So we've discussed three different strategies for trend lines. First one, riding the trend. You try and join the trend in its infancy. Second is fading the trend, which is you wait till the trend breaks down and then take a trade in the opposite direction of that trend and try and ride trend in the opposite direction. And the third one is a combination of the two, in which you look at two different time frames. Example, hourly and 5 minutes or 15 minutes, or daily and 15 minutes, and so on and so forth. Okay, so with this, I conclude how to use trend lines for trading.
Hope you found the contents of this video useful. Please like and subscribe to my channel, and also share the video with others who might benefit from this. Thank you. Namaskar.